Good afternoon. So I'll try to keep you guys awake, now that we're in this post-lunch dip, right? So I'm a computer hacker. Ethical even. So companies, governments, nonprofits, all kinds of organizations hire me in to hack them, tell them how we did it, and then give them tips for how to fix this. So I'm the CEO and co-founder of Radically Open Security, which is a 50-person cybersecurity company based out of Amsterdam in the Netherlands. So this is my second day in Iceland, so I cannot pretend that I actually know or understand very much about Iceland. But I do live in the Netherlands, and that's also a fairly small country. It's also a fairly social country, and hopefully some of my lessons and learnings also from being in the Netherlands hopefully can also translate into the Icelandic context. So I started a social enterprise in the cybersecurity space. Of course, when I say social enterprise, then everybody's like, what does that even mean, right? So the first thing is that roughly 9 years ago, when I first started the company, I sold my company for €1 to a foundation. That's unusual. And the second thing that I did is I used this archaic tax construction called a fiscal fundraising institution, which is a really odd offshoot from the Dutch church. So churches sometimes want to do some kind of a commercial spin-off. They raise money somehow, and then that money goes to the church with a tax benefit. So a famous example of this in the Netherlands is the Language Institute Regina Caeli, otherwise known as the Nuns of Vught, which is a really great quality language institute at which our queen, Maxima, who was originally from Argentina, actually learned her Dutch. Now, the nuns started the Language Institute. The profits go back to the nuns. That's how it works. So we figured, let's make our commercial spin-off a cybersecurity company, and let's make our so-called church something called the NLNet Foundation, which is an internet-related charity that has been funding open source digital rights projects and everything for a better internet for over 30 years. So the funny thing about this FFI construction is it basically forces me to give 90% of my profits to charity at the end of every book year. 90%. The last 10% is my cash flow buffer. That's what I need to make payroll at the end of every month. Of course, people then wonder, but gee, how is that possible? Remember when I speak about profits, this is after my customers have paid me, after all of my contractors have been paid, after we've reinvested for growth and stability of the company. It's only that cash that we would otherwise be dividending out to shareholders, which is quote unquote the cash we don't need, and that gets given in whole to charity. We have a 9-year-old company. It has about 50 people working for it, and we have given roughly €750,000 to this internet charity. So, of course, when I first told people that I was going to create a quote-unquote not-for-profit cybersecurity company, everyone thought I was crazy, right? Or lying, or just full of it. So. But the thing is, it's actually entirely possible to create a company that donates basically 100% of its non-reinvested profits to charity and not only survives on the market, but thrives. Radically Open Security has hundreds of customers, everything from Google to the European Commission, to the Dutch energy grid, banks, insurance companies, hosting providers, telcos, core internet providers, but also nonprofits, NGOs, and civil society organizations for whom we do cost-price services on a not-for-profit basis on a zero margin. So, for example, these little tiny, free speech NGOs, from Iran, they fled and now they create some alternative media. They literally have the world's scariest attacker model. They have a nation state after them, and they have almost no budget. So we're providing them commercial-grade cybersecurity services, exactly the same that I would sell to the banks or to Google, but then at prices that they can afford, because we have no margin on it. So, of course, when I first started my company, I actually came out of academia. I was an assistant professor of computer science at the Free University of Amsterdam. So, the thing about being an academic is, as an academic, you measure your success in positive impact, right? And sort of transitioning with that from, academia into my own startup, I kind of leverage, in that sense, my company the same way that I used to leverage my research team at the university, right? Anyway, applied cybersecurity research is almost the same as what the market needs. So the only difference, of course, is I'm not getting grant or subsidy funding. But to be honest, customers are a lot less work anyway. So basically, it kind of, I didn't know anything at all about business when I started this. As an academic, we had an academic incubator. It was at the Amsterdam Center for Entrepreneurship that my company was incubated. And, I was completely green. I was a noob. I was going through the process, and then you show up at the 1-week startup boot camp. They brought in, somebody from Stanford, who was going to tell us how we need to run our businesses. And, on the first slide of the startup boot camp, what you get is this slide with a picture of an exponential curve on it. And then they say, do that, right? And then the next thing is they tell us that the definition of success for your company is to exit, right? And if you want to be even more successful than that, you do it multiple times, right? Then you're a serial entrepreneur. And of course, if you want to level up after that, then become a VC. Anyhow, but the point was, I was a little bit different in this cohort, right? Because, first of all, I had given my company away to a foundation, which basically meant that I could not sell it. I had created an unsellable company, right? Of course, any VC would be like, what's the point, right? In fact, most of the startup ecosystem would be like, what's the point? But here's the point. If you're thinking about social impact, what is the value, actually, of an exit? We should actually be building companies that are incentivized to persist over the long term, right? And in that sense, also keeping the financial value in the company helps us to achieve that, right? The other thing also is, even with social enterprises, of course, nowadays, if you say social enterprise, half the time people's eyes are going to be rolling anyway, because it seems like, marketing, greenwashing, what does it actually mean these days? And there's a fundamental problem here. One thing is that the word profit, we have the triple bottom line of people, planet, and profit, right? But we know that every time people and planet come into conflict with profit, the profit always wins. It's just a question of to what degree, but the profit always wins. Now, why is this the case? Now, we actually have a fundamental misunderstanding of the word profit itself. We all think we know what profit means, but then do we? The first meaning of the word profit is what I like to call reinvestable margin. In other words, I sell something to somebody, I put a little bit of margin on the top, and I can use that margin to reinvest it into growth and stability of my company, right? So that's the first meaning of the word profit. The second meaning of the word profit is financial extraction. And that is what pays for my private jet and my Lamborghini, and right? And the problem is that these two meanings of the word profit are embedded into the same word. We can't even get it, straight in our heads, because if people say, well, of course my company needs to be profitable to survive, if you're talking about reinvestable margin, spot on. But if you're talking about financial extraction, not only is it harmful, but it is actually a competitive disadvantage on the market. Because all of that cash and financial value that you pull out of the company is money you don't have left for paying people better, for making better quality products and services, for research and development, right? So, So at a certain point then, coming back to the triple bottom line, what we wind up having is people, planet, reinvestable margin, financial extraction. That financial extraction is the greenwashing. And this begs the question of how is it that we get financial extraction out of social enterprise? In fact, we can extend that question even more to say, how do we get financial extraction out of business and finance as a whole? Because after all, any company could be a social enterprise by merit of the fact that it has a value proposition, right? Because it provides some kind of a product or service that society values enough that it's willing to pay something for it, right? We're fulfilling the needs that society has. But that problem comes in the form of this financial extraction. Because here's what winds up happening. First of all, financial extraction is the root cause for never-ending growth. If you want to know about that hockey stick that we were talking about, that exponential curve, exponentiality, you cannot keep it up for very long, mathematically. So if you think about it for 2 seconds, you realize that actually the only purpose of that exponential curve is to get you to the exit in a discrete period of time, preferably 3 to 5 years, right? The other thing also is that the way that we're treating our startups is it's a bit like battery farmed chickens. So those chickens, and they're keeping them in really small cages. And what they're doing is we're taking our startups and we're force feeding them investment capital so they can grow juicy and plump and attractive looking. Until the moment of their liquidation, which is basically the moment when that financial value is ripped out of the company, leaving a dysfunctional carcass of a company left over, right? The other thing that we're doing is we are trying to build unicorns, right? The mythical unicorn that, basically $1 billion US valuation or higher. There's only one problem with the unicorns. 90% of them are bleeding money. And it's not just, older unicorns, just newer unicorns. Every single unicorn that has existed, 90% of them are losing money at a humongous rate. So the problem here is, again, we've got our startup chickens, and we're trying to, basically we've got a system which is like a lottery. And we assume that if we have 10 startups, we know 9 out of every 10 are going to fail, right? So that 10th that succeeds needs to succeed so spectacularly that it, more than compensates for those 9 losses, right? So if you're a founder that just wants to build a moderate success or maybe a nice lifestyle company, if you're working with investors, that's not going to work, right? Because you need to essentially build that company that not only compensates for the non-losses, but it also preferably gets, 10x returns for the investors that put their money in the first place. So, and then at a certain point, I started reading a bit more, I was doing a lot of things intuitively as an entrepreneur, but then I ran into Kate Raworth, who is a really fantastic economist who wrote a book called Donut Economics. If you don't know this book, I very highly recommend it. So, she also has a great TED Talk if you don't have enough time to read. And really one of the questions that she asks is, why is it actually that on a macroeconomic scale that GDP always has to be up and to the right? I mean, the moment that GDP flattens out, what happens? I mean, layoffs, recession, suffering. But why is this the case? Now, the reason why is because there is so much financial extraction out of our economy that our economy needs to continue growing just to maintain this steady state. But the problem is this never-ending need for growth is putting pressure on our societies, and it is putting pressure on our planets. And I think we know by now that this is not sustainable for much longer. So this begs the question of, okay, but then how do we build a post-growth economy, right? Or in fact, how would you even build a degrowth economy? What would happen, if economic growth were going down? Of course, at this point, a lot of people start getting really nervous because, oh, but this means I have to like sacrifice everything and live in a cave, right? But it's not exactly that. Really, the question of how is it that we can thrive in a situation of economic recession, I don't think that's a hypothetical question, actually. I think that's actually where we happen to be at the moment. So I think this question is as relevant as ever. So, so this led me to more explorations. I ran into Tim Jackson, who wrote the wonderful book called Prosperity Without Growth, Jason Hickel, who wrote the degrowth classic Less is More. It really opened up a world for me. I started understanding, the longer I was in the startup ecosystem, why things worked and how exactly, right? Because, again, I came into this as a hacker, as an outsider. I never got an MBA, but that also meant I wasn't indoctrinated through my education. So the more I looked at the system, I started asking, but what are the parts, right? I mean, how do they fit together? How do they move? And most importantly, where do I stick the ice pick, to get it to behave in a completely different way? When you start looking, for example, at venture capital, you start also understanding other things. Most venture capitalists actually are really wonderful people. I know quite a few on a personal level, and especially with impact VCs, they really do mean to make a positive difference. But there's only one problem. It's called fiduciary responsibility. So even the best meaning venture capitalist is legally liable to provide returns for their customers that are called the limited partners. In other words, they have to maximize returns for the shareholders, or they are literally breaking the law. So the problem here is that most of these VCs also operate with fee structures. And most of the time, there's something called 220. So a 2% asset under management fee, 20% carried interest. Now, what this means is if my company grows exponentially and exits, the VC gets 20% of that. Now, I would say that's a pretty powerful motivator, right? So you can literally say that this 20% carried interest in the fee structure embeds the growth imperative into startups. Which means that if you want to create and cultivate an ecosystem of companies that can be sustainable for the long term, then maybe we actually need to modify that fee structure to get rid of that 20% carried interest. 2% is also highly extractive. Most people don't understand this. But given the historical performance of the stock market over 25 years, if I put my money into a retirement fund, something like a Roth IRA or 401k, over those 25 years with a 2% management fee, I will have literally given 2/3 of my returns to the fund manager. Most people don't realize this because they don't understand compounding. If you think of a 2% mortgage, you start to get a gut feeling. But John Bogle, who was the founder of Vanguard and the inventor of the index fund, used to talk about this all the time. It was about the tyranny of the fees and the conflict of interest between the fund managers and the investors. And when he said investors, he actually meant people like you and me. Because in the end, when those cash-bleeding unicorns are, all 90% of them are losing money, we don't ask often enough, whose money are they spending anyway? And it turns out that, for example, in the United States, 65% of the money in American VC funds comes from pension funds. They're spending our money. That's really interesting. But the pension funds, up until recently, there were low interest rates, so they were really trying to move, to a different place on the yield curve. So they were going with higher risk investments because the bonds and safer investments with the low interest rates were basically worthless. In fact, they were losing money on it. But the problem is we've created this startup ecosystem in which 90% of startups fail. Most of the time also, the pension funds even lose money on the exits, because the problem is you're taking these fundamentally cash-losing things, pumping them up, dumping them onto the public markets, and what was fundamentally financially unsound before the IPO is still financially unsound after the IPO. So it's a kind of pump and dump scheme onto the public markets with IPOs. And one might ask the question, why is this even legal? But, and the other thing that we don't realize then is that, the pensions are also then losing money when the market goes down, because of course this kind of speculative, greater fool theory only holds up in growth economies. So then we need to ask the question, well, who actually in this whole system is winning? And it turns out to be the fund managers. Now, as founders, we can choose to not play along in this game. And it's as simple as bootstrapping our companies. You can basically start out by revenue from launching customers rather than immediately assuming you need to start your company via external capital, for example, from a VC. But even in the impact finance space, there is so much room for innovation. One thing that VCs can do is consider applying steward ownership to their funds and reformed fee models as well, to take that extractive 220 and instead change it to get rid of the carried interest and also to make the 2% into the cost of doing business, assuming middle-class salaries and a pension. Because give me one good reason why a fund manager shouldn't be middle class. It just so happens a large percent of the 1% is a fund manager. Anyway, I'm running out of time, so I'm going to wrap this up here. But what I can tell you is that I took a lot of these learnings and I created a class called Post-Growth Entrepreneurship at the University of Amsterdam. I recorded the lectures and they are available online for free. So if anyone is interested in hearing the 11-hour version of this 20-minute talk, just connect with me on LinkedIn, send me a message, and I'm more than happy to point you towards the videos. And the last thing I'm going to say is I also created an incubator called Nonprofit Ventures, and we have incubated over 50 startups with an emphasis on nonprofit entity forms, steward ownership, and cross-subsidizing charity. So we're pumping out small companies that are basically the same thing as what Patagonia is now, after Yvon Chouinard transformed the company, except that it's built into the company from the very beginning instead of the very end. Anyway, thank you so much for listening. And again, if anyone has questions, feel free to hit me up on LinkedIn. So, thank you.